This is one of those moments where you can feel the shift before most people can explain it. Something in the background noise of the markets has changed. The usual rhythm feels off. Prices are moving, narratives are breaking, and the patterns people relied on for years are starting to fail in real time. You didn't click this because you wanted comfort. You clicked because somewhere in the back of your mind, you sensed that the story you've been told about gold, silver, and the broader financial system doesn't fully add up anymore. For weeks now, there's been a predictable ritual in the metals markets. Thursday rolls around, prices soften, Friday follows, and often there's a sharper drop. Traders learned to expect it. They positioned for it. Algorithms were tuned to it. Analysts explained it away as normal weekly behavior, options positioning, or simple profit-taking. But today, Thursday came and went, and that familiar drop never arrived. That alone doesn't make headlines. It doesn't scream crisis. But when a pattern that's been reinforced week after week suddenly breaks, professionals pay attention. Patterns don't break quietly unless something underneath them has shifted. At the same time, the broader world is heating up in ways that markets can't ignore for long. A 10-day deadline has been put on the table regarding Iran's nuclear program. That's not vague rhetoric or distant speculation, that's a clock. History shows that when geopolitical risk moves from open-ended tension to a defined timeline, markets don't wait for the outcome. They begin repricing immediately. Oil doesn't rally 12% in a month because of rumors alone. It rallies because traders, refiners, and governments start hedging real risk. U.S. crude is now at levels not seen since last summer, and the positioning behind that move tells you this isn't just speculative froth. Military assets don't reposition themselves casually either. When nuclear-capable bombers are stationed within operational range and missile defenses are quietly reinforced, that information filters through the system. Prediction markets don't spike to elevated probabilities without participants putting real money behind those odds. Whether an actual strike happens or not is almost beside the point. Wars, or even the credible threat of them, are inflationary by nature. They disrupt supply chains, redirect capital, and force governments to prioritize security over fiscal discipline. Energy moves first, but it never moves alone. Strategic materials follow. Safe haven assets reprice. Physical goods with real-world utility start to matter more than paper promises. This is where gold and silver stop being abstract tickers on a screen and start acting like what they've been for thousands of years. Monetary metals. Gold touching 5,000 and silver pushing toward the high 70s isn't just a number game. It's a reflection of pressure that's been building quietly for decades. For most of that time, price discovery was heavily distorted by paper markets, leverage, and financial engineering. Futures contracts multiplied claims on metal far beyond what existed physically. That system works as long as confidence holds and delivery isn't demanded. But confidence is a fragile thing, and delivery has a way of becoming very important very quickly. Look at what's happening beneath the surface, especially in places that actually consume metal rather than trade paper representations of it. In China, the silver market is sending signals that are impossible to ignore if you're willing to look at them. Spot prices are trading at significant premiums to futures. That structure, known as backwardation, doesn't happen in healthy, well-supplied markets. It happens when buyers are willing to pay more right now because they don't trust future availability. Even more telling is that short sellers are paying deferral fees just to avoid having to deliver metal they don't have. That's not speculation, that's stress. Warehouse inventories tied to major Chinese exchanges have been drawn down to levels last seen more than a decade ago. Merchants on the ground report that whenever metal becomes available, it's gone almost immediately. This isn't driven by one-off panic. It's being fueled by steady industrial demand, investment bar accumulation, and the relentless appetite of solar manufacturing, which consumes silver whether prices are high or low. When physical demand collides with constrained supply, price becomes secondary to availability. That's when paper markets start losing control of the narrative. At the same time, the supply side of the equation is facing realities that can't be fixed with monetary policy or financial innovation. Mining is a slow, capital-intensive business. Discoveries don't happen on demand, and development timelines stretch over decades. For the first time in recorded history, there have been 2 consecutive years with zero meaningful gold discoveries. That has never happened before. It's not just gold either. Across base metals and precious metals alike, the pipeline of major new projects has thinned to a trickle. Years of underinvestment, regulatory hurdles, and low prices hollowed out the industry. You can't turn that around overnight. This makes recent performance from producers especially revealing. When a major silver miner posts record production, explosive revenue growth, and a dramatic turnaround in cash flow, it's tempting to dismiss it as a one-off success story. But when you look closer, it tells a broader story about what happens when metal prices begin to reflect real supply and demand rather than suppressed paper valuations. Record quarterly production paired with massive revenue gains isn't just operational excellence. It's leverage to price. Cash flow surging into the hundreds of millions, treasuries swelling, dividends increasing. These are signals that the economics of mining are changing. And yet, despite all of this, mining equities as a sector remain historically underrepresented in global asset allocation. At their peak in the mid-20th century, mining-related assets accounted for nearly a quarter of global portfolios. Today, that figure sits closer to 4%. That gap doesn't close gently. Mean reversion on that scale doesn't happen through small, incremental moves. It happens through powerful repricing phases where capital scrambles to gain exposure after ignoring a sector for far too long. Gold sits at the center of this entire cycle. It always has. Not because it's shiny or traditional, but because it represents a neutral asset with no counterparty risk. When debt levels expand beyond the realistic capacity of governments to service them honestly, gold steps back into the monetary conversation whether policymakers like it or not. History offers a clear parallel. During the massive debt expansion of World War II, U.S. government obligations were backed by gold to a significant degree. Today, debt levels are even higher in absolute terms, yet gold backing is a fraction of what it once was. Run the numbers without emotion, without hype. If government debt were ever to be credibly backed by gold at levels seen in the past, the implied price of gold would be multiples of where it trades today. That doesn't require conspiracy theories or dramatic predictions. It's simple arithmetic applied to an uncomfortable reality. And while no one is claiming that such backing will happen overnight, markets don't wait for official announcements. They move as confidence erodes and alternatives gain appeal. Central banks have already been voting with their actions. After decades of being net sellers of gold, they quietly reversed course following the global financial crisis. That shift accelerated dramatically after the seizure of sovereign assets and the weaponization of the financial system. For countries outside the Western sphere, holding reserves entirely in dollars and treasuries suddenly looked like a liability rather than a safeguard. Gold, once again, became attractive as a neutral reserve asset. This isn't ideology, it's risk management. What's emerging now is a subtle but profound bifurcation of the global monetary system. On one side, a dollar-centric framework built on ever-expanding debt and financial leverage. On the other, a growing preference for assets that exist outside that system, with gold at the center. Silver, while more volatile and industrial in nature, benefits from both worlds. It straddles the line between monetary metal and critical industrial input. That dual role makes it uniquely sensitive to both monetary stress and real-world demand. Meanwhile, equity markets are flashing signals that seasoned investors recognize as rare. An unusually high percentage of stocks are classified as overbought, even as a significant portion are simultaneously oversold. Under normal conditions, those metrics move in opposite directions. When they rise together, it suggests internal strain beneath headline indices. Capital is being aggressively rotated, not calmly allocated. Historically, such conditions tend to precede major directional moves rather than prolonged stability. Against this backdrop, questions inevitably arise about how prices have been controlled for so long. The mechanics aren't mysterious if you're willing to look. Large players can flood electronic markets with massive sell orders that create the illusion of overwhelming supply. Algorithms react instantly. Smaller traders panic. Prices drop sharply within minutes. Then, those sell orders vanish, never intended to be filled. The same entities quietly accumulate metal at lower prices, resetting the game. This tactic has been documented repeatedly around key expirations and psychological price levels. It works until it doesn't. And that's the critical point. Manipulation relies on confidence and complacency. It relies on participants believing that metal will always be available, that delivery can always be deferred, that paper claims are as good as physical reality. When inventories thin, when backwardation deepens, when deferral fees become routine, that confidence starts to crack. Once physical constraints assert themselves, financial engineering loses its edge. Of course, there are always counter-arguments. Diplomatic deals can diffuse geopolitical tension. Markets can refocus on technology and growth narratives, leaving mining underappreciated for longer than seems reasonable. Seasonal production increases can ease short-term tightness. Corporate results can prove uneven across a sector. Patterns can break temporarily and then reassert themselves. Debt projections assume certain baselines that may or may not materialize. But investing, or even just understanding markets, isn't about clinging to a single narrative. It's about weighing probabilities. Right now, the probability set looks very different than it did even a year ago. A geopolitical clock is ticking, energy prices are responding, physical metal markets in the East are under visible strain, supply pipelines are thin to non-existent, central banks are accumulating gold, not selling it. Debt trajectories continue to steepen with no credible plan for reversal. Equity markets show internal stress, and long-standing price patterns in metals are starting to fail. This isn't about hype or fear. It's about recognizing when multiple independent signals begin to align. That's when regimes change. Not with one dramatic headline, but with a series of quiet confirmations that something old is no longer working the way it used to. The awareness phase of a bull market often feels confusing. Prices rise, pull back, break patterns, and frustrate both bulls and bears. Institutions scramble to adjust models built for a different world. Those paying attention to primary data rather than headlines gain an edge. So as Friday approaches, with options expiring and narratives colliding, the question isn't just whether prices go up or down in the next 24 hours. The real question is whether the forces now in motion can be easily reversed. History suggests they can't. Mining supply doesn't respond quickly. Monetary trust doesn't rebuild overnight. Physical shortages don't resolve through press releases. When these dynamics take hold, they tend to play out over years, not days. This is where logic matters more than emotion, where data matters more than comfort, where understanding structure matters more than guessing price action. If you're here for validation, you won't find it. If you're here to think critically about where the world is heading and how markets respond when long-standing assumptions break, then you're in the right place. This is Uncle John. Stay sharp, verify everything, and don't confuse noise with signal.